All right, good morning, everybody. Thank you for tuning in to this week's S&P 500 sector spider preview. We like to look at the different sectors that consist of the S&P 500 or compose of the S&P 500 and see what's going on with the different trends and levels that they're dealing with. And this is really just a roadmap to what's going on in the markets as opposed to trade recommendations. I think if you have an idea what these different sectors are, it could certainly help your style, regardless of what it is. And I just like to point out that what's driving the market is usually not what the media is talking about. So in financial markets, there are certain price levels that are more significant than others with regards to the amount of supply and demand that exists at them. And you don't need to be some kind of a chart guru or Wall Street guru to realize that. You could just look at any chart and see that there are certain levels that are more important than others with the amount of supply and demand that exists at them. That's why certain levels become significant resistance or support. And we'll take a look at these levels in a few minutes. Prices are always doing one of three things in markets. They're either going up, going down, or staying the same. So if you have an understanding and awareness of where these levels are and what the trends are, I believe it's going to help your strategy, especially if you're a short-term trader. I tell people don't pay attention to things like Gann theory and harmonic charts because it's fun to talk about, but it's not credible. To me, it's like Bigfoot or UFOs. So, and I mean, hey, I'm a big fan of the X-Files. I was just watching the marathon that was on the BBC last week, and obviously a lot of that stuff is about UFOs, but I just don't think that there are UFOs. I mean, I believe there's life elsewhere, but if you pay attention to Einstein and the theory of relativity, they're just too far away for them to ever get here because according to Einstein, nothing can ever go faster than the speed of light. But I guess I'll save that for my astronomy presentation. Just kidding. I don't give astronomy presentations. So this is just kind of the highlights. I'll just zip through this, but if you want, you could print this out off my website. All right, so here is the SPYs, which is the S&P 500, and you can see that they've been consolidating over the last couple weeks. This 286 level that we've been pointing out is support, and that's an important level because it was an all-time top back here, and it was support through here. So going forward, if this level breaks, the next level I'm looking at is down here at 280. That was like the bottom through here, top here, here, and here. So here's a perfect example of how certain levels are more important than others. Obviously, this 286 level is important, right? Why is it important? Well, it's important because that's where a major top was, and this was an all-time high at the time, so that's a major high. So that became resistance here, and it became support here. This 280 level, you can see it was resistance here, 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 support here, and the 260 level was an important bottom. So anyway, I think we're just going to see some further consolidation. The bottom of the range I said is 286. The top of the range is the 291.50 level. That's the top over here and here. So those are levels I'm looking at going forward, and I expect some continued consolidation and then probably some downside because everyone's just too euphoric and people aren't talking about the fact that oil is up 40% over the last year. And I saw a poll that said only 1 in 8 people in the country are worried about the economy, and that's the lowest it's ever been ever in history. And people look at that and say, well, gee, Mark, that's got to be a great sign. Well, to a certain degree, but if it gets too extreme, then it becomes a contrary indicator because if too many people are bullish, they're all fully invested. So there's going to be no one left to drive the markets higher. And when the sellers come in, which they will, because people have to sell things, for instance, to raise money for tuition or mortgages. So there's always going to be sellers, but there's not always going to be buyers because you don't need to buy things. So anyway, I think things are just kind of getting a little extended and, well, not really extended. That's not a good term because it's consolidating, but I think people are just getting too bullish I mean, a lot of these millennials, they don't even really know what a bear market is, right? I mean, remember Netscape? And I was talking to a gentleman yesterday. I'm a little bit too young to remember the '87 crash. I remember when it happened. I was in college, but I wasn't in the market at the time. And he was just talking about the similarities between then and the internet bubble and the housing bubble and what we're seeing now. So this is tech, which is the biggest sector of the market. And you can see it's just been consolidating between the 73 and 75 level. This really brought the market up over the last few months. Downside, if the 73 level breaks, it's probably going to be some support around 71. So see, they got overbought here, and we've just been consolidating ever since. I think this action in financials is kind of interesting. Just having myself a little happy hour cocktail there, and it's not morning, it's afternoon. Usually I do this in the morning, but today I'm doing this after the market closed. So don't worry about my problem, my alcohol problem. So now what's interesting about these financials is you can see here, these things never really participated in this recent rally. This 2850 level, or sorry, 2825 level is important, you know, is the top back here. But I find it curious, or at least worth note, that the financials have not participated in this recent rally. And that could be a bearish sign, another bearish sign like what I was talking about before. And you have interest rates on the rise. Now this long-term chart of this financial spiders, you can see back here in 2007 before the meltdown, is right where the top was in January. Yeah, in January. All right, so if these things do eventually rally, I suspect they're going to hit major resistance around this level, 30.50. So that's something to keep an eye on longer term. And this is also an interesting thing to look at if you don't believe that. If you don't believe in that, I know, or the dynamics I'm talking about are real, there's no academic in the world, or there's no fundamental analyst in the world that can explain how these things have the same valuations at these exact same points, 11 years later. If you look at the SOX index, which we don't look at in this report, the SOX index is at the same level that it was when the NASDAQ market peaked in March of 2000. So that's a little more fuel to the bearish fire, or just something to be aware of. All right, so this is the healthcare spider. You can see it's consolidating, it's a little bit overbought. We pointed out this 92 level. You can see there was support there over the last couple of weeks. The reason why it was an important level is because it was the top back here in February. So if these things see some profit taking, which I suspect they will, look for support at 92. If the 92 level breaks, I think we can get right back down here to like 86.50, 87. So that's much, that's longer term. And you can see this kind of went right up, right? It didn't really, there wasn't much time for it to build a vested interest, or for the players to build a vested interest. So in other words, because it went up so fast, there weren't as many sellers as there would be if it went up slow, okay? And those sellers that got run over, in theory, is what becomes the buyers on the way down, because resistance becomes support. So if you're someone who sold it here, you might say, oh, gee, I'm underwater now. If this thing ever comes back, I'm going to buy more. So just keep an eye on that. That's why gaps refill really quickly. It has to do with vested interest in the amount of time things trade there. So consumer discretionaries continue to consolidate, okay, between like 114 and 117. If the 114 level breaks, and you can see 114 was the top of the range here, if this breaks, we'll probably get right back down to 110, which was the bottom of the range. All right, so just watch those levels. 114 on the downside, 117 on the upside. This is pretty interesting because now we're starting to see the retail crowd really starting to get bullish. And this is the industrials, which obviously has a lot to do with the Dow Jones Industrials. So you can see we've been in this rally, right? But now we're overbought. And we're probably going to see some resistance around this level because this is where the highs were at the beginning of the year, okay, right around the 80 level. So it's overbought. So I highly doubt that's going to break through and it's anything crazy, like shoo, like that. But so overbought, running into these levels. So expect to see some resistance or see these things consolidate and trade sideways for the near future. All right, consumer staples, and this is a good example of how certain levels are more important than others. Like, for instance, look at this 53.50 level. This was support back here in February and March. It was really where the peak was in April. This is hard to see, but they ran into resistance here. This is about a week or two period. Then the trend was broken, and lo and behold, where was the low? 53.50. So this is why you really need to pay attention to these levels, because markets repeat themselves, or markets have memories. Now look at this 50 level. This is a much longer term thing. You can see this 50 level was the top all throughout May. All right. Now let's take a look at a longer. All right, look how important this 50 level was. This was the top all throughout 2015. You might say, well, gee, Mark, it got above it there. Well, that's like 51. So, I mean, I'm sorry if I was off by $1 on a $50 stock. You can see the low in last September, a year ago, was right there. So longer term, if this thing heads lower, I think there's going to be real significant support of 50. If that breaks, then we're going to see a pretty significant sell-off, in my opinion. All right, here's energy, which you probably remember. I entered that trade back here, but we got stopped out for a small loss because I thought when we were going to break the 74 level, we were going to see some significant downside. I think that this could have been some kind of a trading error here. Okay, because obviously I'm not the only person in the world that's watching the 74 level. You could see it was resistance here and support throughout here. Anyway, that broke and went, had a significant drop, but then it came right back. And when I say trade error, think about this. For instance, say some hedge fund is selling this thing and they want to be 10% of the volume. And just to keep the numbers very simple, say 1 million shares is on the tape or 1 million shares is traded. Well, then they have sold 100,000 shares. Now, say all of a sudden a big block goes up of 2 million shares. One institution sells to another and a big block goes up. Now there's 3 million shares on the tape. So this algorithm needs to sell 200,000 shares to catch up. So it can be 300,000 shares, which is 10% of 3 million, right? So if the trader doesn't know what they're doing, or if the algorithm isn't programmed correctly, it could have just come out here and just keep this thing down, which is why it went right back up. But going forward, the lows here were around 72. So I would look around 72 for support. I think this 74 level, I don't know, maybe it's kind of diminished in importance. But going forward, we're certainly going to keep an eye on it. Now look at the 78 level longer term too, right? So there's a top here, and we can see in this longer term chart how important 78 is. So this is the end of 2016, and then this is what I just showed you early in the year and recently. So again, you don't need to be a chart guru or some kind of stock market master to see that the 78 level is important. So if this thing rallies, I would expect significant resistance at the 78 level again. All right, now here's materials, which is basically been about as exciting as watching paint dry since June, but it did have a day where it traded above this 60 level, which has been the top of the recent range. It is overbought, so we'll have to see. But if it consolidates, I would be looking for 60 for support, obviously. The 6150 level for resistance, because look, 6150 was resistance back here in March and February, and it was resistance here in, it's probably June. So again, you can see certain levels are more important than others, right? Look at this 58 level. You don't need to be some kind of trading guru or master to see that that's a support level. And what does that mean? Well, it means there could be some big institutions that say, when this thing gets to 58, make a stand and buy it. Don't let it get below. I just want to acquire the stock. It has nothing to do with fundamentals or Turkish lira or anything like that. It's just supply and demand dynamics. All right. And then last but not least, utilities. All right, you can see they've really just been consolidating around this 54 level since the beginning of August. If they head lower, look for some support around 52. There's the bottom here, top here. If they break that, I'd look at 49 for the next support level. So, all right, well, anyway, so that's it. That's a quick look at the S&P sectors. Just remember a couple things to think about that. I did this on my blog a week or two ago, but it's just some chinks in the armor to think about. One is you have these financials are not participating in the rally. Two is you have oil up 40% in the last year. And then three, you're starting to see some of these sentiment indicators, which could be indicative of extremes, which are contrary indicators. So I think those are some of the headwinds facing the equities markets. All right, well, that's it. Thank you for tuning in, and please join us next week, and I look forward to talking to you then. Thank you.